You've sold an investment, a business, or maybe that rental property you've been babysitting for years. You're ready to enjoy the proceeds, but HMRC have other ideas. Capital gains tax can quietly eat into your wealth, and most people don't even realise they've overpaid until it's too late. In this video, I'll explain what CGT is, when it applies, the current rates, and smart and entirely legal ways to reduce it. Hi, I'm Alifa, Chartered Financial Advisor, and today we are talking tax. Capital gains tax to be precise. But before we get into this, please hit the subscribe button below to support our growing channel. So, capital gains tax, what is it? Well, capital gains tax, or CGT, is a tax on the gains you make on an asset. The difference between what you paid for an asset and what you sold it for after deducting certain costs. It exists to raise revenue for the government and to try to keep the tax system fair so people can't just reclassify income as capital gains and avoid income tax altogether. Chargeable assets include property that is not your main residence, so buy-to-lets, holiday homes and commercial units, shares and investments except when held inside ISAs and pensions, business assets including goodwill and shares in your own company, or high-value personal possessions, so antiques, artwork, classic cars, jewellery. CGT applies when you sell an asset, or you gift it, unless it's to a spouse or civil partner, swap assets, or receive compensation for a lost or damaged asset. So let's say you bought a Rolex for £12,000 and later sold it for £18,000. The proceeds, £18,000, minus the purchase price of £12,000, gives you a gain of £6,000. It is this gain or profit that you pay tax on. Each year we all get a tax-free allowance. This year that allowance is £3,000 per person. So using our Rolex example, we can deduct £3,000 from the £6,000 gain, and capital gains tax is only due on the remaining £3,000. Allowable costs you can deduct from the gain are purchase costs, so the price paid, legal fees and stamp duty, selling costs, so these might be agents' commissions, marketing costs that are related to that sale, and legal fees. Capital improvements, for example adding a conservatory to a property. This does not include the cost of general repairs though. Or losses can offset gains in the same tax year or be carried forward, but I will come on to that later. For 2025-26, basic rate taxpayers pay 18% on residential property and 18% on other assets. Higher and additional rate taxpayers pay 24% on residential property and also 24% on other assets. So here's an example. You buy a house for £200,000. You sell that house for £340,000. That's a £140,000 gain. Now deduct your £3,000 annual allowance, and that leaves £137,000, which is taxable. If you're an additional rate taxpayer and it's a rental property, £137,000 times 24% is equal to £32,880 of capital gains tax. So here's where some people can get confused. Imagine you earn £30,000 from salary and you sell an asset for a £50,000 gain. The basic rate tax band is £37,700. Your £30,000 salary uses up most of this, leaving £7,700 for gains taxed at 18%. The rest of the gain sits above that threshold and gets taxed at 24%. It's not that the gain pushed you into a higher income tax band, it's that the gain sits on top of your income when working out which CGT rate applies. HMRC do offer some reliefs on CGT. Principal private residence relief. Main homes are usually exempt. Business asset disposal relief. This means you only pay a rate of 14% from April 2025 for qualifying disposals, up to a £1 million lifetime limit. Holdover relief means you defer CGT when gifting certain business assets. Spousal transfers between husband and wife are also exempt from CGT. And ISAs and pensions shelter you from CGT completely. So here's a real-world CGT reduction story. I've protected my client's identity by changing their names. Martin is a successful business owner. He owns 3 buy-to-let properties and he no longer wanted to manage one of them. Complete nightmare tenants. He bought the property 10 years ago for £200,000 and had a buyer at £340,000. A nice profit until he worked out the CGT. As an additional rate taxpayer, Martin will be paying HMRC 24% on nearly all of the gain. Martin also owned some shares he'd accumulated over the years outside of an ISA or pension. They had cost him about £20,000 but were now only worth £8,000. Martin's wife also didn't work. She had stayed at home to raise the kids while he ran the business. Now, before signing the sale contract on the property, we transferred half the property into his wife's name and we sold his shares at a £12,000 loss. Without this planning, Martin's sale price was £340,000, the purchase price was £200,000, giving a gain of £140,000, less his annual allowance of £3,000, leaving a gain of £137,000. HMRC would have taxed all of this at 24%, leaving a £32,880 CGT bill. With this planning, the gain was split 50-50, so £70,000 for Martin, £70,000 for his wife. Martin offset his £12,000 share loss, so reduced his gain to £58,000, less his annual CGT allowance of £3,000, and this left the gain of £55,000. Taxed at 24%, he would owe HMRC £13,200. His wife now also had a taxable gain of £70,000. Less her annual CGT allowance of £3,000, this left a gain of £67,000. Because she didn't work, the first £37,700 would be charged at 18%, which equals £6,786. The remaining £29,300 would be taxed at 24%, equaling £7,032, giving a total for her of £13,818. So the total CGT paid after the planning was £27,018. This means a total saving of £5,862. By simply shifting ownership before the sale and making smart use of a loss, Martin kept nearly £6,000 in his own pocket, money that's now sitting in his ISA, growing tax-free for his future. So remember, CGT is on your profit, not the sale price. But without planning, the tax can still be eye-watering. Use your allowances, consider spousal transfers, offset losses, and seek expert advice before you sign, because once you've paid CGT, it's often very difficult to get back. Leave your questions in the comments below, and if there's a common theme, I'll cover it in a future video. Thank you all for watching to the end. Please hit the subscribe button to support our growing channel, and I'll see you again next time.